Welcome to the HC Commodities Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Jeff, welcome back to the show.
Well, thank you. It's a pleasure to be here again.
Yeah, I was looking back. So the last time we had you in late 2022, where essentially our discussion was around the supercycle and the impact then of monetary supply in the wake of tightening to prevent inflation. But let's just start there. Where are we at in the commodities supercycle, and are you still a believer in it?
Absolutely still a believer in it. Yeah, I know it's been a rough couple of 18 months lately for those that are the believers. Why don't I just go over why it's actually a stronger case today than it was then? And then there was some, temporary setbacks. But let's talk about, the core argument from back then and what does the argument look like today? If you recall, the argument had a structural supply story, what we called the revenge of the old economy. Was capital was redirected into the new economy, choking off investments in the old economy that would have allowed them to grow the supply base. Yeah, I know you had the surprise in U.S. shale, but let's take that aside. The amount of capital flowing into this space is just simply not adequate. I like to take the Magnificent Seven. Last year, they had a $47 billion cash flow. I'm going to put that against Exxon's. Now, on average, those seven companies did. Exxon had $60 billion. It trades 1/5 of the value of those Magnificent Seven. Well, maybe not anymore. Some of them come off recently, but it goes to the point I'm trying to say here is the capital in the space. Yes, it has gone up in some of the mining and so forth, is still far below what would be adequate to grow the supply base. And I don't want to get into the reasons why. And look at drilling, rig counts, and so on down the line. The investment simply is not there. Let's talk about the demand side. That is what's really different from the last time we spoke. Before, we primarily talked about deglobalization. The war had just kicked off between Russia and Ukraine, and talked about defense spending. But the big one we talked about back then was decarbonization. In fact, now I like to call them the 3 Ds: decarbonization, deglobalization, and data centers, AI. And when you think about commodities, and particularly a commodity like copper, it engulfs all 3 of those dynamics. Obviously, you need the copper. In fact, I like to say that, AI is chips in copper. You need the copper to create the flow of the electrons to these data centers, and data centers themselves have copper in them. Then when we think about the deglobalization theme, defense spending, this year alone in 2024, we'll see $85 billion of investment in via the IRA, but the defense spending in the U.S. is $95 billion. These are big numbers. So we're seeing it play out with these 3 Ds. And the way they're being captured is in global Capex. Capex is rising. In fact, one thing you've heard me say in the past is a commodity super cycle is nothing other than a Capex cycle. Obviously, that's what impacts metals, but the stimulus effects into the old economy, which employs far more people than the new economy, create stimulus throughout the system that leads to more oil demand and other food demand and commodity demand more general. That's that lower income argument we've been making for years. So, we look at the supply picture, it's still intact from when the last time we talked. And then when we look at the demand picture, it's stronger today than what it was previously. So, I'm still a big believer in this super cycle.
Just on that supply side, can you just recap why you think we haven't seen the flows into commodities that we would normally have seen at this point in that Capex cycle? And secondly, is there a bit of a bifurcation going on where we are seeing money flow into the mining sector? It's got a good narrative for investors. It's also got a narrative that's, around decarbonisation as well? And are we seeing the challenges really on the hydrocarbon economy, where there's still that crimp on investment, not least because of these assets are typically 20, 30-year assets, and the timeline just doesn't fit with kind of expectations of the rapidity of the energy transition. I know there's a lot there, but can you just recap that?
In general, investors like the metals more than they like the energy for the reasons you cite. And I like to say metals have an anchor, energy doesn't. And that lack of an anchor forces the market to swing from extremes. I've been doing this a long time. I've never seen Brent net short. And it was a few weeks ago. Even in the catastrophic moments of the last 30 years, this market got short. They don't like it. The fundamentals of oil are better today than they are for copper, but you can't give oil away to investors, yet you can give them copper. But that said, the interest even in copper is not sufficient. Free cash flow yields are in excess of 15%. People do not like this space. And by the way, it's not unique to commodity producers. Most of the old economy is struggling today. When you look at, you get outside of those magnificent seven, the overall market is not, in a healthy place right now. In fact, if anything, they rolled over more recently. But when we think about, the level, going back this revenge of the old economy, the new economy is still taking in too much capital. When we think about this, even AI itself is energy constrained. So you need to be putting some money to work into the space. Yeah, they go into some of the independent power producers into the U.S., but let me remind everybody, you still need the gas and you still need the fuels to help power those power stations to be able to meet that demand. And to give you an idea, most of this investment can, at the margin, be fossil fuels. You look at Dominion Resources; they just commissioned 9 new plants to meet their data center demand. Of those 9, they're all going to be gas-fired. So we're seeing, at the physical level, the direction into the commodities, but at the financial level, the interest there is still, I would say, cautious, even at the metal side. And if you look at, there's no commodity, hedge funds. I don't want to say no, but there's very little commodity hedge funds outside of the multi-strats. And here's a key point. The multi-strats, they're trenders. They're not traders. They have to wait for the market to trend. And most of these commodities still aren't trending. You look at copper, you're quite positive, and I'm positive on copper. It's at $9,600 a ton right now. It's been there since 2021. That's not a trendy market. That's a sideways market. It's not one that's capturing a lot of interest. Yes, there was a lot of excitement, 4 or 5 weeks ago, when we rallied, from an 8 handle up to over 11 handle, but we're back into the middle of that trading range at $9,600, $9,700 a ton. So that's why I go, super cycle fatigue. People are giving up on it.
But we were talking just before we started that actually, if you look at the trend line of commodities, the indexes, since 2019, it's essentially been a positive line upwards. Really, you just got that sort of blip to the upside in 2022 as a result of obviously Russia's invasion in Ukraine primarily. But, the narrative is certainly there. It's just, as you say, investors aren't necessarily following that. And I want to play out some scenarios about kind of whether that means a very volatile future still, these big moves to the upside that you talked about in copper a couple of years ago. Before we get there, the one other commodity that we haven't actually discussed ever is obviously gold that's doing things. Can you give us your account there?
Yeah, I think that's really important because it sheds a lot of light on what's gone wrong here. And because actually the biggest 2 movers on your screen this year are gold and Bitcoin. I want to emphasize the move in gold, just the added market cap is bigger than all of cryptocurrencies put together. It's a $12 trillion market globally, and it was up like 30%, which is larger than less than $2 trillion of market cap inside the crypto. So these are big moves, biggest on your screen. And they, it's actually surprising people aren't spending more time focused on it because it tells you a lot about what's happening. So let's take a step back and ask what happened here after the Ukraine war. and why has it changed the timeline for this play out in commodity prices. And I want to start with the quote unquote immaculate disinflation. And when we think about the immaculate disinflation, I want to point out when you look at CPIs around the world, they all declined at exactly the same time. That's point number one. Point number two, they occurred at record oil demand, record food demand, and record demand. And they also occurred at very strong demand growth in economic growth in the United States and China, because China was growing 5% back in that point. So you put those three observations together. That tells you it could not have been demand driven. It had to be supply driven. Nothing else could give you that observation. Okay, if it's supply driven, where did policymakers get the supply? Three places: turning a blind eye to sanctions, turning a blind eye to environmental policy, and turning a blind eye to immigration policy. So they got more energy, more food, and more labor that helped ease the situation. All those are one-offs and not repeatable. And politically, they're costly. Letting Iran pump, nearly 1 million barrels per day of extra oil after the war, that's a lot of revenue, and it offsets the amount of money they're spending with Ukraine and Israel on munitions, and then let them, produce this stuff. But it also is leading to Iranian-backed Houthis taking pot shots at warships. I don't know how long this is going to go on till after the war. The one thing I will say, inflation is 10 times more important to investors than foreign policy. Actually, 10 times more to, voters than foreign policy. 10 times more important to voters than even climate change, which brings me to the second one, turning a blind eye to environmental policies. They backtracked. If it was, here in the UK, Sweden, go around the world. And the big two I want to focus on are coal. China, Indonesia, India, producing record amounts of coal, huge increase, bigger than Saudi Arabia, more than 7 million barrels a day. That's a lot of coal. That's a lot of energy that supplants, even natural gas around the world. And the other one is, they cut down mangroves in the Philippines for, palm oil, and even in places like Brazil, deforestation for soybeans. So the bottom line, they got more food and more energy by, basically backing away from environmental policies. And then the third one, obviously, is immigration. Here in the UK, it was 2x. US up 50%. So that did a lot. But I want to emphasize these are one-offs. And then you add the SPR in there, call all that political oil. That's more than 500 million barrels of oil put onto the global market. Turn that coal into oil equivalent. You're getting over 1 billion barrels of extra supply added to this market over that time period. That is going to push it off substantially. Now I want to tie this into gold. So we look at that environment over that same time period. We saw, interest rates go up substantially. The dollar strengthened. It's surprisingly how strong the dollar has been over that time period. One is that the rate hikes have been fairly aggressive. But it also led to a rise in real rates. Any other time, what would that lead to? Stronger dollar, higher real rates, gold goes down. But from that time forward, gold has gone up as rates have gone down. Basically, you have somebody out there buying gold, selling treasuries. Who could possibly be buying gold and selling treasuries after, the war started? All of the EM countries, they're not in the market for U.S. treasuries anymore. Why? The asset freeze of the central bank on Russia. You're vulnerable if you own those treasuries. Why China was selling and buying gold. Just look at the spread between those two. And then we just look at the rates, because you sell the treasuries, the rates go up, and then you buy the gold goes up. And then you put it, that you can look at that wedge that's created in what was a historically very stable relationship. And so now I'm going to ask, okay, what is the other fly in the ointment here that pushed off the supercycle thesis? It's a strong dollar. Because typically what would happen, and this is missing, and I think copper would be at 14,000, oil would be over $100 a barrel, if you saw the traditional dollar recycling. What is a dollar recycling? You're China or you're Saudi Arabia. You earn dollars off sales of your exported goods. Historically, you take those excess dollars, buy U.S. treasuries. That would lead to lower yields in America. The lower yields would weaken the dollar. The weaker dollar would reinforce growth and inflation outside of the U.S. or in inflationary pressures in dollar-denominated assets. And then that would lead to more dollars, and those more dollars would buy more U.S. treasuries. That's why you had that negative correlation between oil dollar and commodities in dollar, is because of that recycling. It's been absolutely absent since the Russian central bank asset freeze. I don't want to get into their minds and what's causing it. It's just, it's probably not coincidental. Those two things coincide at the exact same time, but we did lose that recycling. That's helped, create a stronger dollar against, the higher yields in the U.S. treasuries. But it also has led to more gold because you have those central banks having to do something that liquidity in their buying gold. Is this going to stop? Absolutely not. They got to keep up with their reserves, which is why they continuously buy. I know there was a little hiccup it was about 3 weeks ago. A report showed the PBOC for 1 month didn't buy gold. People thought the trend. I don't argue 1 month makes a trend. I tend to think this dynamic is going to be with us for quite some time. And I don't know if we're going to ever go back to that same recycling, but that was the virtuous cycle there that really helped out commodities and, helped that super cycle in the 70s and the one in the 2000s again.
Yeah. We had Jonah Van Borg on talking about sort of the broadly de-dollarization, but he really did highlight that asset freeze, and obviously now the interest payments are going to Ukraine, and it would obviously be a momentous moment if actually that money was confiscated. Because, that seemed to be a real watershed in American finance, right? That suddenly the realization that the dollar, had strings attached. So all of those reasons were, the immaculate disinflation, as you highlighted, all of those are one-offs. And we're also in a year with the largest electorate ever going to the polls. And much of the discussion is around immigration and obviously now with Israel's war in Gaza, that's also highlighting international policy and so forth. Sort of talking about future scenarios that accelerate these trends, just starting there is, we're in a particularly risky political climate. It's driven by a lot of populism globally. That could have a profound effect, I assume, if suddenly the immigration taps were truly turned off.
Yeah, when we laid out the super cycle thesis in October of 2020, one of the key tenets to it, we called it at the time, it was redlining commodity demand, RED. It was the R stand for redistributional policies. It played out, in spades over the following year or so. You've got income inequality and wealth inequality in most of these countries around the world at record levels. That was the cost of globalization. And part of deglobalization is unwinding that income inequality. And a lot of that civil unrest and voter unrest you're seeing around the world is in response to this income inequality. And as they address it, and by the way, that's the one thing about, the situation in the U.S., the low unemployment rate. When you have unemployment rates this low, those are going to that lower income group. And so they're getting more jobs, more money. And the point I made back then, and it still holds true today, is those lower income groups are the core of commodity demand. They are what creates the demand at the margin. I'd like to point out, a rich guy is going to eat the same amount of corn throughout the cycle. It's that lower income guy that's going to change how much corn he eats across the cycle. And so when we think about, as you put more money and reallocate into those lower income groups trying to solve this problem, and that's what they're trying to do in these elections, it's most likely going to lead to structurally higher commodity demand. I just like to point out with oil demand, what do we know for the last 3 years? It does nothing but surprise to the upside. And one of the reasons it surprises to the upside has to do with this larger preponderance of lower income groups responding, to governments trying to deal with this income inequality in a way that's boosting commodity demand. So, I think it's going to be And I like to point out is they all roads lead to the same place. You take the IRA, you're solving the decarbonization story, but it does two things. It deglobalizes you because you're going to be depending upon local investments. Because think about electrons don't move, electrons stay at home, only molecules move. But it also, here's the other point: who gets those lower income jobs, or who gets those IRA based jobs? It's going to be the lower income groups. So you're solving that income inequality problem at the same time. And every country in this world is doing this stuff at exactly the same time.
Does it survive the elections that are coming up, particularly obviously the US one? Ultimately, are these macro trends that are sort of unavoidable and here to stay in the wake of energy transition and deglobalization?
By the way, I definitely believe they're here to stay. You look at Trump and you look at Biden. Both of them are industrial policy people. That's telling you both of your choices are focused on the state protecting the industrial base. That is a far cry from where we were in the 80s. I like to point out, when we look at energy transition in dealing with it, I always like to point out this it's a fact. The right, conservatives, Republicans, whatever you want to call them, have been the ones most successful in creating environmental policy that actually achieves something. The left has never been capable of it. And it's a fact. I'm not trying to make any political situation. You go back to Teddy Roosevelt, Richard Nixon with the EPA, the Clean Air Act Amendment, and then you had Thatcher, Reagan, George Bush Sr. But you notice the list stops after the 80s. So now is this observation because the 80s in that period was so market focused as opposed to state intervention? They were unwinding the state at that point in time, whether you're left or right. It happened that the right was in power at that time. Why am I bringing this up? Is because they focused on being technologically agnostic in letting the engineers and the market figure out the solution. I know there was some guy probably sitting back in the 60s sounding like me going, by the way, it was called desulfurization or the war on acid rain. Remember, it was all that smog, the London fog and was smog, or you had the smog in Los Angeles. We got rid of all of that. But the key point is they stayed technologically agnostic. Now, I used to always make the observation that, the reason why was the right would stay technologically agnostic and the left wouldn't. Now, the reality is that was a period people believed in the market at a very deep level of market-based solutions. They'd just been burnt by state intervention solutions starting in the mid-60s throughout the 70s. So they weren't going to go back to that. And I sit there and I talk about it today. I go, well, are we going to go back to that depending on the markets to solve this? By the way, we all know, we learned it in Econ 101. The right way to deal with this whole war on carbon is let's start with a carbon tax, carbon price.
Yeah, give it a price. Yeah.
But we're not going to get there. It goes back to my point. And by the way, everybody thinks that, Trump's going to get rid of the green. I don't know if he will. And the reason why is the IRA primarily benefits red states. But the other reason is why not just make the U.S. if you're Trump, make it a energy powerhouse. Do gas, oil, coal, solar, wind, nuclear, just do it all. But here's the most important reason why I don't think he's going to turn on it is because what is China trying to do right now and flood the world with green Capex? You already have Biden responding, the same way Trump would with really relatively high tariffs against it. The difference between the two are starting to recede. But I think the key observation here, and I think going back to your question about all of these elections around the world, there's a greater dependence upon the state today than any time since the 70s when you had the likes of Reagan and Thatcher come in and tear down those all of that regulatory and state intervention around the world. I think the point being here is we're a long ways away from the call it the 80s, where we depended upon on markets. Actually, I just want to, my career at Goldman really tells you all of that globalization is. You think about all of these markets, they really didn't exist, the macro markets like FX rates and commodities pre-Reagan. Reagan came in and invented the modern day bond market. Why? He came in with no debt. He was able to launch these markets that created the rates markets. And then I got to Goldman in 96, 95, and that period. And that's when all the deregulation in commodities occurred. And then in 97, during the Asian financial crisis, you pulled all the pegs off of the currencies around the world, and then they started floating. So by 2000, we were making markets and everything, and that was the mentality. That mentality is gone, and it has been replaced with this greater mentality of a focus on the state solving the problem. I could talk for hours ad lib on this, but I think it's worth making the point that difference between the left and the right today is less than the difference of both the left and right today versus what they were in the 80s and the 90s.
Well, and what's fascinating, I agree with you, people need to sort of reopen their Hayek books, but we're also sort of and this isn't one to get into, but there is sort of this post-economic man voting these days, where you have, particularly in the United States, a whole swathe of people, particularly in rural areas, essentially voting against their economic interests. And actually, it's fascinating how will these elections be about an economy, or are they going to be about other cultural shibboleths? But leave that there.
The energy and resources sector is experiencing unprecedented change. To help companies navigate this world and capture its opportunities, HC Group launched Enco Insights in 2023. Enco has rapidly become the leading global expert network dedicated to energy and resources. Enco Insights leverages HC Group's 20 years of connections and dedication to the sector to give clients the expertise they need to take decisions fast. Connect with Enco's experts for anything from a 1-hour insight call to a longer-term consulting project at encoinsights.com.
Okay, so building the picture, going back to that deglobalization, there's sort of the macro view, which is, of course, countries are seeking their own sovereign security in energy supply. That works well with electrons, as you pointed out, versus molecules. What that is certainly doing is going to be rising costs as you go to the least, you start moving away from the most efficient producer of whatever commodity it is. The second aspect of deglobalization is events. We'll come on to that. But is that picture still in place? Are we truly seeing a globalized decoupling, that deglobalization? Are we really seeing countries, companies seeking alternative sources of supply, shifting operations, spreading operations out? Can you just, is that really here, or is that just sort of a nascent narrative?
In some of the core commodities like energy, the Chinese are doing it. They're weaning themselves off of the oil right now as we speak. They may not be replacing it with clean energy, but they're replacing it with electricity. Maybe it's powered by coal. But the bottom line, EV sales and a dependence upon locally produced electricity has exploded in China. And you're seeing that, less so in Europe because they're exposed to, having to import other alternative sources, and the Chinese are willing to burn the coal to produce the electricity. But, the broader comment I'd like to say that what we really have seen, and this goes to more point with the onshoring and offshoring that you're referring to, the answer is no. All we've seen is a redirection of traffic, of shipping, transportation. And what does that do? It creates the probability of supplies, chain snags, inflationary pressures, all of the other things that come with it. But, the bottom line is the Russian oil goes to India now, it gets refined in diesel, and the diesel comes back into Europe. So they didn't take the Russian oil. That's the kind of dynamic that we actually see in finished goods and everything around the world right now. But to your point, are we actually seeing it In things like food and energy, the answer is yes. In broader manufacturing goods, the answer is no.
Yeah, all of which does raise prices and does support the narrative. The second element of that is the more volatile world in general. There's, and it's we always have a tendency to think our own times are the most volatile and all the rest of it, but it does seem there's multiple potential flashpoints around the world, that are disrupting, could have big shocks on the market. Obviously, we've had Russia's invasion of Ukraine being the big one. There's Taiwan, but you mentioned the Houthis earlier on. That's having a substantial effect and could have a very great effect on prices and oil flows as well. Can you just give us some sense of kind of, how volatile are is the world right now in your opinion? And are those events that could really trigger that kind of upside volatility that we saw in 2022?
Well, I mean, when you look at the modern world, which really kicked off with industrialization in let's say 1820, and by the way, the British, when they defeated the Napoleon, their use of carbon, at the industrial level, whether it was in steel making, everything, they could outproduce anyone else in the world, and that was really carbon. They were the ones who figured out carbon is mobile muscle. You can move it around, and that was what I would argue really created the wealth creation for Britain during that time period. But the reason why I'm going to bring this up is let's go from, let's say, 1820 until around 1920. For 100 years, the world had one global superpower, and you can see once they put the coal on the ships in 1870. So for 50 years, from 1870 to 1915 or something like that, 45, 50 years, that's when globalization first really occurred. It works when you have one entity out there policing the seas. So it stops after World War I, and we just get more fragmented. But the key point here, and I'm going to say what's parallel to the 1920s versus to today, was the income and wealth inequality. The globalization creates vast amounts of wealth for a small group of people, and everybody else gets shut down. That's when you had the rise of socialism and everything like that. It was that civil unrest and income inequality around the world that created a lot of the problems. And at the time, Germany was China and Britain was America. And, the British Poles, they were very upset at the Germans at that point in time. And it's a very similar dynamic between China and the U.S. And I say, these things happen in cycles. So you go, when was the world this volatile, this uncertain? Well, you got to go back to that period from, in that 1920 period, right around the First World War. And it stayed that way until right around 1987, when the Soviet Union finally fell, and then Reagan, and then Bush, and then Clinton rolled out all of those, like NAFTA and everything like that started to globalize the world again. And it stayed that way up until now. So, where we are in this globalization cycle, or whatever you want to call it, I'd argue, it's par for the course the way the world looked, after once, people started challenging the Brits back around, call it 1920. It's a very similar dynamic as it is today. And once you lose that stabilization of the big policeman, the situation starts to get, more unstable, more volatile. And I think that's where we are at this point right now. No way do I want to try to, forecast the decline of the U.S. and, given the quote unquote exceptionalism that's going on there. But it did the cost of that exceptionalism is a lot of people missing out on the wealth creation, and that group that's missing out on the wealth creation are pretty upset right now.
Yeah, which actually takes us back to our previous discussion, and we're both fans of Edward Chancellor. These periods of ultra low interest rates, artificially low interest rates, are foundational to that growing income inequality, when essentially assets are worth more relatively than labor, right? So this is all that the hangover from that period.
And by the way, when we look at, at least in the modern period where we have data, all these super cycles are preceded by periods of low, stable interest rates in a big equity bubble. And it's because, again, you're sucking too much capital into the bubble period, but you're also creating that income and wealth inequality that creates that uncertainty going forward.
Okay, so putting this all together, you're a believer in the super cycle. You've outlined multiple reasons on the supply side that have existed now for some time, and highlighting the demand piece and the changes there. What is the trajectory, as best you can, right? Is this a long, steady increase in prices, or are we going to see that kind of the Trafigura thesis of higher spikes more often, trajectory?
Well, the one thing, I made the point over and over since the beginning of making this, a super cycle is not a big steady upward rise in prices. People forget the 2000s was like that. You had your first big spike was in 04, 05. And then 06, you came off. The Fed was raising rates. Everybody was thinking this is over, Currie. You don't know what you're talking about. And then you started cutting rates in late 07, and you're off the races again. And then it collapsed into 09. And then it spiked for a final big rally into 11 and 12. With, if you look at everything put together, it wasn't the high in oil, but the very, very high was in March of 2011. You hit nearly 10,800 on copper then. You look at the company valuations, everything maxed out there. So it was three big spikes. Here I have to agree that with Trafigura that they're going to be more frequent now. And that's the par for the course for the energy transition. It's because, they're going to get one part. Prices of power in Europe are going negative more often than not. That tells you they haven't built out the grid yet. As the investment catches up on the grid side, then they can start creating tightness in things like gas. But I think the key point here is the one conclusion we can come from for energy transition. It says the vol is going to be high, which means you put that in the context of a super cycle. It means each spike will be higher than the last, with the low higher than the last low. And that's probably the way these markets are going to look over the next decade or longer.
Yeah, especially, and we've highlighted a few times on this podcast as well, that a lot of the reasons that grid isn't getting built and actually investment isn't going in, despite the incentives around things like the IRA, is actually the policy and procedure side that's behind it all. Getting permissions to build something is incredibly hard, right? And you're not seeing a commensurate tackling of the regulatory side of what needs to happen for the energy transition, not around markets and so forth, that's really stalling that. And you don't really see anything that's going to break that deadlock in certain in states, in the UK in particular. And the other thing that worries me, you spoke earlier about state intervention. If you look at the in the previous super cycle, there was, as you highlighted, that fundamental belief that the markets will solve this. It was a big period of liberalization of commodity markets in the late 90s, the early 2000s, particularly in Western Europe and the US. However, more recently, when we've seen big price spikes, the reaction has been essentially market intervention. Whether that's stopping the free flow of commodities that we've seen, India shut off foodstuffs and cotton and so forth, and you've seen, obviously the energy crisis in Europe. There was no real recognition that had there not have been a free, liberalized energy market, it wouldn't have been solved, right? The actual reaction was one of more intervention. So it seems like that's a real danger point as well. If you don't have regulators and legislators that are, that believe in the free flow of commodities, and this is where we get, it seems like all of this put together, we're heading into kind of a period of rising protectionism, which will have a real force multiplier effect on commodity prices.
Without question. And it's just, it's going to push markets higher. We're just going, in fact, if anything, going back to that period between 1920 and let's call it 1979 when Volcker came in. That was a period, Volcker was the start of unwinding all of that mess that was created from, what is that? That was almost 50 years. And I think, we're going back to that very, what was that period from, call it 1920 to 1978. I guess that is 50 years. It was nothing but started off with tariffs, trade wars, and the frictions got bigger and bigger, Cold Wars, all of it. to the point that the state was driving everything. Places like here in the UK required a Thatcher to come in there and unwind it all. I don't want to forecast, 50 years, but my guess, we're just at the beginning of this process, and it's going to get deeper and deeper into it. It's unfortunate that we're, maybe it's the Chicago in me, being a Chicago trained economist, that I really believe in the markets. But it's a shame that this is the world we live in today, when we're trying to solve what's probably the most important problem for the world in terms of dealing with the carbon problem. Because I'm a firm believer markets would have solved this problem a lot faster, a lot cheaper than human beings. You need the investment. On that point, I just want to say, at this point, why we don't know, and this kind of goes into what Energy Pathways does, here at Carlyle, is we don't know the pathway between brown and green. I'd like to point out, in the 1970s, is there anybody listening to this podcast today who knew that if you put platinum and palladium into your exhaust pipe, you would solve the aerosol problem? The answer is no. You had trials, and by the way, it wasn't a car company, an oil company, or somebody like that solved the war on acid rain. It was BASF and Engelhardt who invented these technologies. And I always have a saying: don't bet against the engineer. Give them enough time and money, they will solve the problem. Which is why you need to stay technologically agnostic. And so at Carlyle, this whole idea of the energy pathways is we don't know that pathway, just like we didn't know you had to put platinum and palladium into your tailpipe. We need to trial that. And markets are the best thing possible at doing that. Actually, when you think about Obama couldn't pass the carbon price and tax, I think it was 2010, because by that point in time, people were so upset with 08, 09, they just didn't trust the markets anymore. So, I'm not going to say there wasn't a bad side to that wonderful, in economics parlance, we call it the arrow de Brew world. That was the beauty of, call it 1980 to some call it 2009, 10, where we depended upon the markets. I do think they would have been a better answer trying to deal with this problem of decarbonization today.
Yeah, and that is the missing piece, isn't it? The price of carbon is the piece that unlocks, the ability to make those investment decisions. At the moment, that's so, volatile, and ultimately, unfortunately, in some cases, we're seeing investment into essentially purely sort of legislated markets, right? Some of the biofuels and so forth that really economically don't stand up, and are somewhat questionable in terms of their contribution to the energy transition.
But here's the problem. You take like Sweden, they'll change those mandates. Renewable jet fuel trades 3 times that of regular jet fuel. And the reason why is the mandates. But if the governments don't show conviction and then they back off when the going gets tough, then you're going to open yourself up to, hey, I'm not going to make that investment anyway, because you're clearly going to backtrack on these mandates. So they're creating a problem with the mandates, is that there's not a level of conviction and stability in them that would allow the investment to occur anyway.
Yeah, and I do find it fascinating, right? We know the end point of the energy transition, but as you say, we just don't know what the various pathways could be, and there could be, every day you read the news and there's, solid state batteries just got 1,000 times better, or fusion made one step close, made closer, and it's managing that volatility is very difficult. But without a vibrant commodity trading sector, you're not going to be able to get there, right? Because you're not going to have the efficient allocation of capital and flows in commodities in form and time and space and so forth to actually enable these decisions. Well, before we wrap up entirely, Jeff, it is, can you just give us some sense of what the the energy pathways is and where you're at with that, and what the current stage is?
Well, going back to the point about this energy transition thus far has been nothing short of chaotic and disorganized, and part of that is because it's had such a focus of only being on the green side. But let's remember, the word transition means we're transitioning from brown to green. You need to think about it holistically and look at brown and green together. One of the mottos here at Carlyle is invest, don't divest. And I like to point out that The only way you control the emissions is to own the emissions. If you divest from your portfolio, you're just pushing them off to some place like China, India, and you're doing nothing to reduce the emissions. In fact, that's my problem with net zero, is that the focus so far is make yourself net zero, but don't do anything to the overall level. The focus needs to be on emissions today in the brown sector and putting them down. And so the idea is combine the brown and the green together and focus on the pathways between the brown and the green. And essentially the idea here is, it goes back to that point we were saying with platinum and palladium, is to take a less of a convicted approach here and let the trial and error help find that pathway. And just one last thing I want to point is, by doing this, you create a portfolio with the brown and the green together. The value of the portfolio is worth more than the sum of the parts. Because if you're decarbonizing a brown asset and you eventually make it a green asset, you're going to take that brown cash flow and give it a green multiple, which is something that's far more worth than each of the individual assets. The second point is they hedge the technology risk. Like to think, take Tesla versus Ford. Ford does brown and green with ICE in EVs. Tesla only does EVs. Who got hit harder with the Chinese dumping EVs on the world? It was Tesla, not Ford, because they were hedged by having both. And, the policy risk, the technology risk, also inflation risk. Think about this. If you do brown only, you're going to miss out on the growth of AI. If you do green only, you expose your portfolio to the inflation from oil from not investing in oil. By doing both, you've hedged yourself, and then you get the benefits of both stories. Anyway, I can go on to this point over and over. Thanks for asking, Paul, but I'm super excited about it.
As well, Jeff, it's been a real pleasure having you back on, and I look forward to having you back on in a year or so and see where we are. But I tend to agree with you that there's lots of risk out there, but it's a risk to the upside in terms of commodity prices when you piece it all together.
No, thanks for having me on, Paul. It's always a pleasure.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.